So this is the exact problem that is on the test that uses this. So if you remember from like homework or your basically intro problem, with NPV, what you're doing is a lot of times with the intro problems, they're giving you the interest rate. And this is one that's more of an intermediate level NPV problem, but also something that's very easy to try to get a hold of. So what we do in this case is we've got the problem that we've already gone over. You've got a company that is considering expansion to a new market. It's going to cost 1.5 million. So we've already figured out what our cap M is, 10.7%. So what we're going to do now is figure out what NPV is. So on the financial calculator, if you go over and hit the CF button, you will see cash flows. Now, this is very, 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 very important to do. So you see that I already have cash flows entered in this calculator. So what you want to do is you want to hit second and then clear. That clears everything out of there. So that's very important because, like, say, in this problem, we have 5 years worth of cash flows. Well, let's say in the previous problem, we had 10 years of cash flows. Well, guess what happens to those cash flows from year 6 through 10 if you don't go in and do the all clear? Well, they show up in there and those cash flows are in there. And then your answer is going to be totally messed up. And with a totally messed up answer, you're going to be wondering, hey, what did I do? I didn't do, I thought I did all the steps right, I entered in the stuff right. Well, that's the one thing you didn't do was clear it out. So huge thing. Make sure you hit second and clear on the TI, and that clears out all your work. And you'll be able to do a lot more things by doing it that way. And it just gives you a clean slate to start with. So CF0 is how much is this project costing us in year zero? Well, we see in the problem, the project costs 1.5 million. So we type in 1500000. So we have 1.5 million. This is also very important. Enter this in as a negative because that first cash outflow is an outflow. It's not an inflow. No project is going to yield you a positive return at T0. It just doesn't work like that. T0 is always going to be a cash outflow. So what we do after we do that, you hit enter, not the equal sign, but enter, like ENTER, enter, and then hit the down arrow. And then you get to C01, and C01 is 400,000. So you enter in 400,000 and then enter, and then the down arrow. So when you click the down arrow once, it says F01. F01 means the frequency of payments. So like if you're doing a monthly payment or something like that, your F01 would be 12. Or if it's semi-annual, it'd be 2. So what we're going to do is these are all just annual cash flows. So we're going to keep the F01 and the F02 and the F03 and so on at 1. We're not going to adjust it. So we're just going to hit the down arrow again. Our C02 is also 400,000. So I hit 400,000, I hit enter, and then I hit the down arrow. Again, F02, we're not going to change. And then I hit it again and go to C03. C03 is 500,000. So I hit 500,000. Then I hit enter. And then I hit the down arrow. And again, F03, we're not changing. So we hit the down arrow again, go to C04. C04, the cash flow in year 4 is 250,000. So we enter in 250,000, enter, down arrow, down arrow. C05 is 300,000. So I enter in 300,000, and then I hit enter, and then I stop after I hit enter because I'm all done entering in the cash flows at that point. So all I have to do then is go to NPV where it says I equals. Now keep in mind we're using cap M, which was 10.7. So we put in 10.7. And when you put this in the calculator, another important thing to remember, you put the 10.7 in as a whole number. You don't have to decimalize it and put it in as 0.017. The calculator will automatically do that kind of work for you. So it's very important that you enter it as a whole number, or again, your answer will be messed up. So then I hit enter, ENTER, and then hit the down arrow. And where it says NPV equals, right now it's showing nothing. Or if you'd previously worked an NPV problem, it would show you what the previous NPV answer is. So don't be confused, it's not the answer. NPV is not equal to that, so we would hit compute. And the answer is negative 96,739. So we have a negative answer for NPV. So if you remember in capital budgeting, the decision rule for NPV is if if your interest rate or your cost of capital is lower than your rate of return, then you would reject the project. Also, if NPV is negative, you reject. If NPV is positive, you accept. So in this case, we have a negative NPV, which means we reject the project. So let's go on and do the NPV using CAPM. And when we do the NPV using CAPM, what we have here is the same thing. Sorry, we just did NPV using CAPM. NPV using WACC. So keep in mind, if we go to the cash flows, we don't have to re-enter these in because they're the exact same. Cash flows did not change. The only thing that changed in this problem was when we hit NPV, I equals instead of 10.7, our WACC was 3.5. And then we hit enter, and then we hit the down arrow, and then compute. And our NPV using WACC is 181,301. So that's a positive NPV. So we would accept it using WACC, but we would reject it using CAPM. So now let's go over the internal rate of return. So the thing is, mathematically, how you would figure out what the IRR is would be this. IRR conceptually is the interest rate when NPV is equal to 0. So how you would figure this out by hand would be, okay, well, I think the IRR would be, say 7. Does that give us an NPV of 0 if I put in NPV equals and 7? And if it's a little high, or if you have too much of a positive NPV, then you would raise that a little bit. If it's negative, you would lower that a little bit. But it's really easy to do on the modern versions of the TI calculator. All you have to do is hit IRR and then compute. And you see in this case, our IRR is 7.95. So what is the decision rule regarding this? Well, if IRR is greater than your cost of capital, then you would accept the project because, layman's terms, you're making more interest than it's costing you. And so anytime you can do that, you would want to take on the project. However, the problem is we're using two different interest rates here that are giving us conflicting answers. So under WACC, you would be like, yeah, accept this thing. Under CAPM, where your CAPM is 10.7, you would reject it. Now, why are WACC and CAPM so different? Well, one of the main reasons is CAPM is considering risk. The WACC is just what your cost of capital is. However, that doesn't tell us what the risk of a project is because not all projects are the same. So, let's say, for instance, I'll use Walmart as an example here. If Walmart wants to open a new store in, we'll say, Columbus, Ohio, Walmart already has 6 locations in Columbus, Ohio. So if they open a 7th, they already have a really good idea of what to expect. Okay, we're opening up in a burgeoning area of town that a lot of new housing starts are going on. Population is moving there. We're going to open a new Walmart there. They have a really good idea of what their cash flows are going to look like because they have a basis of comparison. But let's say Walmart is going to open its first ever location in, we'll call it Dublin, Ireland. Well, how is the risk of Dublin, Ireland going to compare with the risk of Columbus, Ohio? It's way riskier because it's a totally different market. Walmart doesn't necessarily have all the supply chain connections in Ireland that they might have in Ohio. They don't have the cash flow estimation ability in Ireland that they would have in Ohio. And it's a lot more risky of a project. Doesn't mean it won't succeed or that it's not a good idea, But if we're doing an apples to apples comparison, it is a riskier project. So that's something you want to keep in mind. So the next thing we want to look at here is the payback period. So what the payback period means is that in the absence of interest, how long does it take you to pay back something? So in other words, a thing would be like this. You come up to me on the street and you're like, hey, can I borrow 20 bucks? And my question would be, my first question is, when am I getting this $20 back? And you say, oh, I get paid Friday. I'll give it to you Friday. Well, that's my payback period. Well, I know exactly what day I'm going to get it back and how many days it's going to take in order to pay back. And let's say it's a close friend, a family member, something like that. I'm not going to charge interest. That's what payback period means. So in this problem, what we're doing is figuring out how long does it take to pay back that initial investment of 1.5 million. So what I'm going to do is go clear it out, and I'm going to start with 1.5 million. And this is a negative, keep in mind, because that is a cash outflow. So how long is it going to be before this becomes zero? That's the question. So year one, we make back 400,000. So I put in 400,000. So at the end of year one, we still have not paid back 1.1 million. Year two, we have cash flows of 400,000. So I'm going to add that 400,000. So at the end of year two, we still owe 700,000. Year three is 500,000. So I'm going to add back 500,000 to that. And at the end of year three, we still owe 200,000. So in year four, we get cash flows of 250,000. We only owe 200,000. So we know that that payback period lies sometime between year three and year four, because that's our remainder. So all we have to do is take this 200,000 and divide it by the year four cash flows, 250,000, and it gives us 0.8. So our answer is the payback period is 3.8 years. And that is the answer to the problem. So the final part of this problem is this: should we accept or reject this particular thing? And the answer is it's inconclusive. NPV is saying that if we're using WACC, we accept. If we're using CAPM, we reject. So it's inconclusive because we have one saying yes, one saying no. So therefore, we don't know exactly what the answer is. Now, when you get into more complicated problems, what we're going to do is weighted NPVs where we have different scenarios involved. And so in the next set of videos, that's what we're doing, is the more complicated questions where we're actually doing a little bit of a Monte Carlo analysis or a scenario analysis and showing exactly, okay, under multiple scenarios, what would be our expected NPV. And so I hope this video really clarified things for you. If you enjoy the video, please comment below, smash the like button, and everybody, good luck when studying for this, and we will be posting more.